name is Ben Nyhart, and today I'll be talking to you about McDonald's and an in-depth look at the financial stability of Mickey D's. The project overview, we're asked to analyze the Dow 30. Then we're asked to choose a company that we like based on certain financial ratios. Today I'm going to explain to you how I came to this decision, provide a detailed analysis of each of the major financial ratios, and I'm also going to compare McDonald's to the industry average, which is the restaurant industry, obviously, and then what I expect the future stock price to be. The method that I used to come up with my company, to come up with McDonald's, is I started with all of the ROEs for the Dow 30. Then I took the ones with the strongest ROEs and used the DuPont analysis to take a closer look at each of the ROEs and what was causing the ROEs to be as high or as low as they were. Now there were some other companies that had a higher ROE than McDonald's. In fact, it was IBM, Boeing, and CAT all had a higher ROE, but these were driven by financial leverage. Not a significantly high leverage. In the case of Boeing, it was really high, but in McDonald's and the IBM and CAT's case, it was just a little bit higher than for my liking. So I went with McDonald's because it had the highest ROE of the ones that was left. And then we also had, and I also looked at ROA and profit margin. Return on assets, McDonald's was number one in ROA, so I liked that. And then we also took a look at the price earnings, price to book, and EPS ratios. I looked at the other companies, all of them, they were similar, and in some of these areas there were a lot of companies that were similar, but I liked the consistency that McDonald's had with reference to these. And also, we also looked at EVA and the weighted average cost of capital. These were significant for McDonald's because they had a huge economic value added for the past 5 years, and it has grown over the past 5 years. And along with that, the weighted average cost of capital has actually dropped each year as well. And then, of course, we also looked at the volatility and the risk measures for McDonald's. Well, we looked at beta, standard deviation, and a little relative volatility. And then we also took a look at supply chain just to see what McDonald's has along the supply chain. A little background on McDonald's. It was founded in 1948. The initial public offering in 1965 was at $22.50 a share. McDonald's, as of yesterday, is closed at about $100 a share, roughly. I like McDonald's because it operates in 119 countries worldwide, which means it is a very diverse company. They have always been leaders in the restaurant industry. They also have a diverse menu all across the world, so they change their menu to fit each country that they're in, which I like because they can kind of fit in with each different culture as well. And then finally we had, McDonald's had $27 billion in sales last year with nearly a 20% profit margin. We also like that as well. Why I chose McDonald's? Well, McDonald's has a huge market cap, just over $100 billion, so it's a huge company. We know that McDonald's isn't going anywhere anytime soon, so we do like that. They also, as I mentioned earlier, they had a strong ROE, 36.82 for 2012, and then their average over the past 5 years has been 34.51. They've never dropped below 30, and also we do like the ROE that's high because it's not due to leverage. Their leverage was a little bit over 2 for the past 5 years. In the reference to the market or the industry, it's usually at the restaurant industry somewhere in the 4 to 5 area. The highest ROA, we like that. Return on assets, they're very efficient with their assets. They do get a high return on their assets. We also found out that McDonald's was liquid, so they're able to pay their financial obligations. McDonald's is very profitable. They have almost, like I said earlier, almost a 20% profit margin, which is one of the higher profit margins in the Dow 30. A high economic value added, so that just reminds me that they are growing They had an EVA that increased over the past 5 years, and then they also had an increasing earnings per share as well. And then as far as the risk goes, they had a very low beta, somewhere around I believe it's less than 1. It's probably right at around 0.5. They also had a low volatility. They had some points where they did have a little volatile areas, but for the main part, they were consistent, and they had the volatility kind of remained very stable. All right, McDonald's ROE, the return on equity is the amount of net income returned as a percentage of shareholders' equity. Return on equity measures a corporation's profitability by revealing how much profit a company generates with the money shareholders have invested. Now, like I said, McDonald's ROE was very high, 36.82, which was fourth in the Dow 30 for 2012. Now, the industry average for the restaurant industry was the restaurant industry has a pretty high ROE, considering they're right at around 29. Also, like I said earlier as well, McDonald's has had an ROE over 30 for the past 5 years. Also, like I said, the other companies did have higher ROEs, and this is a good place to start for us. But I mean, the ROEs for the other companies were just a little bit too highly levered for my liking. So then we did the DuPont analysis for ROE, which is the breakdown of ROE. First, we have the tax burden, which we really don't care too much about because unless it's really affecting the ROE, it's hard for the companies. Well, it's impossible for the companies to control what happens in their taxes and interest. And then that's multiplied by EBIT margin, and then total asset turnover, and also equity multiplier, which our main focus here is probably what is driving the high ROE. In McDonald's case, it was the high EBIT margin, which is EBIT over sales. Basically, it's saying that McDonald's is highly profitable over the past 5 years. That's what has been driving their high ROE. We also looked at liquidity measures. We don't really want to spend too much time on this. We do want to know whether a company is liquid or not, whether they're able to to tell us to be able to pay their short-term liabilities with their short-term assets. In this case, McDonald's is well over 1 with their current assets as opposed to their current liabilities. So we're good there. We're going to move on to the ROA and profit margin. These are also part of ROE. The ROA it just tells you how profitable a company is relative to its total assets. It kind of tells us a little bit of their asset efficiency. It's calculated by dividing the total annual earnings by its total assets. And then we also, like I mentioned earlier, McDonald's had the highest ROA in the Dow 30. We did like that very much. And then the profit margin also is very high, which we also like as well, which is almost 20%. And then the restaurant industry, the profit margins were somewhere around 10%. So McDonald's is double what the restaurant industry was. And also the profit margin as relative to the Dow 30 was pretty high up there. It was definitely the top 10. I don't know the exact number, but I know it was very high relative to the Dow 30 as well. Then I took a look at price earnings ratio. Basically, it's a ratio that basically takes the current stock price compared to its per share earnings. A higher PE does suggest that the investors expect a higher return in the future. Basically, they expect the company to grow in the future. McDonald's was right at about 16. They were pretty stable in the PE ratio area. They were pretty stable. I think one year they got up to 19. But for the most part, we're going to use PE ratio to project future earnings. That's basically what we want to look at here. That PE is just kind of what a shareholder is willing to pay for each dollar of earnings. And then we just like to point out that the denominator is an accounting measure. That's why I don't put a whole lot of stock into PE ratio, because the earnings is an accounting measure and these numbers can be manipulated. The price to book. Basically just the market price of a company's shares over its book value of equity. Basically it tells us if the company is trading for less than book value, the market believes that the value of the asset is overstated, or the company has a poor ROE. In this case, McDonald's had a 5.78 price to book, very standard, right at around where it should be. Nothing indicating that it would be trading, too high or too low. If anything, the lower price to book was kind of a good thing for McDonald's. The EPS, we also looked at that. Basically, the portion of a company's profit that allocated to each outstanding share of common stock. Earnings per share is another profitability measure as well. McDonald's was right at a little over 5, and they had grown over the past 5 years, which is a good thing. We want to see that the earnings are growing. That way we know that the company is growing. And again, McDonald's had a growing EPS since 2008, so we like that as well. We're going to move on to economic value added and also weighted average cost of capital. These two are interconnected. The EVA is basically what we have left after we pay the shareholders. And in 2012, we had a big number of almost $4 billion of EVA. So after all the shareholders were paid, we had $4 million that was added to McDonald's. We also like that it has increased over the past 5 years, which also shows that the company McDonald's is still growing, and we're growing even more profitable every year. We'll also look at it as while EVA is growing, the weighted average cost of capital should be going down, and in this case it is as well. Basically with the weighted average, what it costs to raise capital for a company. With the return, also the equity side is what kind of return do our shareholders expect. So in McDonald's case, they had a relatively low as far as the Dow 30 is concerned, and that was probably right in the top 10 as well. And for the restaurant industry as a whole, McDonald's was the leader in WACC with a 6.71, and it has decreased every year since 2008, which we'd expect with the rising EVA. Also, we have it also means McDonald's is becoming less risky because investors are expecting a less return over the past 5 years. That's why the WACC is going down, because investors are expecting are wanting a less return. And this is what we saw on the this is about economic value added. It shows the weighted average cost of capital here. We have up here, it shows the weight of equity and the weight of debt. Nothing that scares us here. It's very well proportioned. Then it tells you, the cost. The shareholders expect a 7.3% return. Debt holders are about 1.8. And then we weight these, and then we come up with a weighted average cost of 6.5%. We also like to look over here at the NOPAT, and then after the NOPAT is $6 billion, and then we also have a total investment capital of $30 billion. And then we basically take our NOPAT minus our capital charge to get our EVA. And then we also have our return on invested capital of almost 20%, so it's very high, we like that. And then we have our EVA spread here, which is going to be our return on invested capital subtracted from our weighted average cost of capital, which basically tells us how well McDonald's is doing on their investments. So they're earning almost, 13.5% on their investment. So we like that as well. And then here on the bottom, we do like the little graph here. So down here, we can see McDonald's kind of had an increase in WACC. We had a spike here in 2008, which we would expect because of the crisis. And then ever since then, we've just been steadily going down, which we really like. We also looked at supply chain. Just some things to point out here. These companies had a pretty high percentage. These are the 3 highest percentage of revenue for McDonald's, and then we also they looked at their competitors as well. And I also will show you a graph on the next page of how the competitors were doing with relevance to McDonald's, which we'll see in a couple slides. And then we took a look at risk and volatility. The standard deviation for McDonald's over the past 5 years is 0.24. A little bit high because they had a high number in 2011, so it is a little bit skewed, but for the most part, they're staying in the 0.15 area, somewhere in that area. We also like that the beta for 5 years, for the past 5 years, has been at 0.65, which means that it's less risky than the market. We also saw that the market volatility was 11.54, while McDonald's over the past 90 days has been 11.5, which would say it is less volatile than the market. This was the only company in the Dow 30 that had a volatility that was less than the market. So we do like that. It's more of a stable company as well. And this here is going to be our competition. McDonald's here is the blue line. Now we see it's very stable as our return climbs. Very stable. We like that. And as you can see, like we're here where we have Yum, which is Taco Bell and KFC. They drop, they come back up. You can see the line is a little bit more steady, which we like because it's just it says that our volatility is lower than the rest of these companies. Now we didn't out-earn, our returns didn't quite get as high as Domino's there, but we like the fact that it's stable, and we can kind of expect a return that's very stable as well. And here, the next slide I'm going to show you, this is going to be return as opposed to the S&P 500. Our average return for McDonald's over the past 5 years has been nearly 13%. So that means every year stockholders can expect a return of 13%. Now we know that future returns are going to be dependent on other things, but we do like that it has been growing over the past 5 years. Also, the dividend growth has grown by an average of 15.8% a year as well. And then we look here at the graph that we have. This is the return for McDonald's, and then in the blue that you see here. And then we have the return on the S&P, which you see here in the green. As you can tell, McDonald's has outperformed the S&P since 2008. So we do like that as well. What I expect in the future, I calculated what I figured, or what I thought the expected price should be over the upcoming years. So what we did here is we took our expected earnings per share, we multiplied it times our average PE, and we had McDonald's having a share price of about 100.03 per share, which is right about what they're trading at now. We also took a look at the earnings, the expected return. So we took our share price that we got here, we added our expected dividends, then we subtracted that from what yesterday's price was, and then we divided by that price as well, and we came up with an earnings expected return of 3.88%. Do I expect it to be higher? Yes, I do. This is, like I said earlier, some of these earnings and things are accounting measures, so we don't really put a whole lot of stock into this, but we do like to see that according to this, we'll be having almost a 4% return. I also looked at the dividend discount model. According to Bloomberg, it's dividends per share over your discount rate minus your growth rate. The dividends that we expect to see in this year for 2013 is going to be about $3.15 per share. And we also, according to Bloomberg assessment of McDonald's dividend discount model, we see that the theoretical share price should be at 155.54 cents, which we think that's a little high, but we do like the fact that it is 50% higher than what McDonald's is trading at right now. So do I think it's going to get to 155? maybe eventually, but we just like the fact that we expect it to grow. So moving on, this is my conclusions. I like to call these my little McNuggets to leave you with. That's right. And in this case, we have a 6-piece McNuggets. At first, we like McDonald's because they're attractive at first glance because we have a high ROE. Now, ROE doesn't mean everything. It's a good place to start. We have to look at everything else that goes into ROE as well as the other ratios that we have. I also love McDonald's consistency. The earnings per share grew. The ROE has been growing. It's been consistent. Profit margin has grown or stayed consistent, and the ROA has been the same. Been relatively the same over the past 5 years. And then we like the risk return. Like I said earlier, we had a return over the past 5 years of almost 13% per year, and then our risk is relatively low, with our standard deviation being right in this steady area of about 0.15. We do like that McDonald's is liquid, also because we know that if something were to happen, McDonald's has enough liquidity to pay their obligations. And we also like that the EVA is climbing while WACC is falling. We love that. That means McDonald's is still growing, and we still have a potential for future growth. We also like that the expected returns, they are going to be, we said about 4% according to our earnings model, and then if we're listening to the dividend discount model, we expect a huge return. We probably expect something in between those two. And we like it because the returns have been growing over the past 5 years, and we expect them to grow in the future. Thank you.